Good day to all of you. Welcome again for another training session in fundamental and technical analysis. So this is the 16th week we are doing this, and last week we started to discuss about candlestick patterns. So that was the first part of it, and I said that there will be a few more sessions coming on the same topic. So this is the second week we are going to discuss about candlestick patterns. And as always, Saliya will be doing today's session as well. And let me also remind you, if you haven't subscribed to our channel, please subscribe so you will get all our updates on a regular basis. Saliya, over to you.
Thank you, Charitha. Welcome all of you, and it's a pleasure covering the session with regards to candlestick patterns. And today, as we were discussing last week, we will be talking about the dual candle patterns or two candlestick patterns. And to open it up, I'm going to take you all through the pattern called engulfing patterns. And as I mentioned here, you have two types of engulfing patterns. One is the bullish engulfing pattern and the bearish engulfing pattern. This is a trend reversal pattern, and we normally watch for this formation most of the time. I mean, to make use of this pattern accurately, we need to wait for the peaks and the troughs. In other words, when I have mentioned, when there is an uptrend, there are pauses, and over here also you have a pause. Uptrend starts at the bottom and moving up on a higher low, higher high formation, and pauses at a certain level. And the pause is called the resistance. And you have two types of resistance levels. One is called the resistance point or resistance level itself, and the other one is the resistance zone. So there are many things that are happening at a resistance level or that resistance area or area of resistance, which is also known as the resistance zone. And this pattern, the engulfing pattern, is one of those patterns that we see on the resistance point or resistance areas. So we got to be mindful that many things that are happening as far as price action is concerned happens not only at a certain point, it happens within a range or within a zone. That is very important if we are interested in moving forward with technical analysis. Therefore, when it comes to the pattern at the peak, which is the resistance area, we encounter the pattern called bearish engulfing. In a bearish engulfing, as I mentioned, it happens after an uptrend is paused. So in an uptrend, you will see higher lows and higher high formations. And at one point, you will see the last candle before the pause, or the last candle at the point of the pause is a bullish candle, a green candle. And the next candle, if we see a formation of this nature, and incidentally, as I start, at the outset, I mentioned that these are dual candles or two candle patterns. So basically you have to, this is a daily chart. So the period is plotted in days. So basically you need to wait for 2 days for this pattern to form. So then the following day, you will see a candle formation like this. Now, why it is known as an engulfing pattern is because the entire body of the previous candle, that is the entire body of the first candle, is overlapped or engulfed by the body of the second candle, as we can see here. And when we see this formation where a green candle is followed by a red candle or a white candle followed by a black candle, that is a reversal point, right? So, and as a result of that, it is known as a bearish engulfing pattern. Now, when I was just going through this chart of John Keel's during this period, I managed to locate many patterns of that nature. And here you can see that I have spotted 4 periods where this candle pattern had been formed. There also you can see, if you draw your attention very closely, the distance or the range of the body of these candles are different. If we start from here, you can see that the range of this body, which is called a tall candle or tall bodied candle, the green one. Then you can see that the overshadowing or overlapping of the red candle is taller than the green candle. But when it comes to, we'll come in a minute to the Doji bearish engulfing. But before that, you can see here the body is short compared to the previous one, and the body of the red candle is much taller, or it's relatively larger. And here also you can see that the red candle and the distance between these two, of the range of the open and the close of the two are pretty long. Over here you can see that it is not so. It is short in nature, but at the same time we can see that the green body is engulfed by the red body. So this is known as a bearish engulfing pattern. Now, whilst we have the bearish engulfing pattern, the opposite of that is when the prices make a downtrend, comes down and make a pause either at a support level or a support zone. You can see if you are talking of a support and a support zone, you can see that these two candles are showing similar highs. In fact, the high was 140 on this candle, then the next candle also 140. Thereafter, I mean, both instances, the close was lower than the opening, which continued, you can see, continue the downtrend that had started, in fact, at this point. Thereafter, you can see that the highs have become lower, making a lower high formation with lower low formation. And thereafter, we can see here that the pause took place. But between this level to this level, you can see that there is a support range that has formed, ultimately making another pattern that we discussed some time ago, which is an ascending triangle pattern. Now in between, you can see over here that there is a red candle, which is almost like a spinning top candle. The body of which candle was engulfed by the green candle, the body of the green candle. Incidentally, when we are discussing about the engulfing patterns, we primarily discuss or we focus our attention to the bodies, not the shadows. But that does not necessarily mean that we don't take bodies into consideration. You can, there are certain, there is one approach where the analyst takes the body and the entire range, including the shadows, into consideration when they are looking at the engulfing pattern. But in general, the most common practice is to focus our attention to the bodies only, right? So here you have the body, which is an engulfing pattern. And from there onwards, after making this lower slow, we can see the lows have been increasing. After this, a strong horizontal resistance, there is a breakout. Then that started going up. You see up and down waves forming, within which we can see the lows have started increasing along with the highs. And at this point, again, as I mentioned, there is a bearish engulfing pattern, which made the trend reverse to this level. And at this point, once again, you can see a red candle followed by a green candle where the body is engulfing the red candle. Thereafter, we can see the trend had started moving up, again making a bearish, bullish engulfing pattern, then moving on to make a bearish engulfing pattern, and then comes down to find another support with a bullish engulfing pattern. And you can see several patterns of that nature over, at this, short period of time. Another important thing that we need to understand, just like any other pattern, be it candlestick patterns or, normal support and normal chart patterns that we discussed some time ago, the successful patterns will always follow the primary trend. Now here, I can tell you, before moving on to that, I have mentioned a Doji bearish engulfing pattern here. What it means is that you will see a formation where a Doji candle, meaning a directionless, indecisive candle, is followed by a bearish long candle, which covers or engulf the middle part of the candle. And you will encounter in certain instances that the entire candle, the distance, meaning from the top to the bottom, the entire distance will be overlapped by the following candle. And in this case, it's a bearish engulfing Doji candle. But of course, you will encounter seeing Doji bullish engulfing patterns as well. Right, so you have these two types of candle formation. The first type is to do with the normal full or rather large candles with bodies, and meaning both candles, the dual candles will be with bodies, and the other formation is with a Doji on either side, especially when it comes to, in the engulfing pattern, always the overshadowing we look at from the second candle. That is also very important to understand. Here, the Doji is the first candle. The second candle is the larger candle, which is engulfing the first candle. And all these candles are the same. That's that. When we see that formation only, are known as bullish or bearish engulfing patterns. Now coming back to the major trend, we have to be very familiar with the overall or the bigger trend or the longer trend when we are looking at taking positions or cutting down our positions, right? So here you can see that overall picture. If you take in this chart that we see in this window, remember, in an uptrend, we analyze or we focus on higher lows and higher highs. You can clearly see here how the lows are increasing, at the same time how the highs are also increasing, right? I mentioned that whenever there are breakouts in an uptrend, the breakouts have to happen on the resistance or the highs. Here you can see, not only here, over here you can see that there is a breakout above this area, moving up to this level. Then there is a high-low formation. Then there is a breakout above this Doji candle and moving up to this level. Then comes down, respecting the high-low formation. Then there is a breakout, then final breakout above this level. Ultimately, you can see for the prices to come up to this level, there had been breakouts out of the resistance, or rather, the breakouts have taken place out of the resistance levels and moved up. So this is a classic uptrend that we are in. Then the other thing is the accuracy or the success of either the bullish or the bearish engulfing pattern is clearly seen here as a result of this uptrend. Whoever took positions with a stop loss below this area would have not got out of that trade due to stopping the trade. What does it mean? Always when we take positions for trading with the intention of cutting loss with a stop loss rule, right? We always look at the previous lows. If you are taking a long position, we look at the previous lows or previous levels where we are deciding to place a stop or decide to sell by taking a loss, right? In this instance, if we were to take a stop, it would have been at this area, ideally a little below this swing low formation that we can see here, which is below this level, right? Now, when we are here, we don't know anything about what is happening over here, right? At this point, we see an engulfing formation, and we decide by using this pattern to buy with a stop below this level, right? So in a primary trend where the trend is upwards, right? The position or the long position that we took would have succeeded because it didn't come down to make a stop there. Thereafter, again, we can see another over here, right? Now, let's say we have taken a position there, and thereafter we had exited the trade, or we could even exit the trade at this point. Or otherwise, let's say, without doing that, we had our own shares and we wanted to short that by using this, right? There are again the same story. If we are shorting our own stock, since the short selling is not available, you can short your own stock, but with the same rules. Meaning, if you had taken a position where you have sold with a stop at the previous highs, which is over here, right? If this was the stop area, right? Then if you had made use of the price range of this candle, or if you waited for a retest to take a position where you're going to go short of your own stock with a stop at this level, right? And with a target price, it has to be a relatively, a decent target price. So let's say you were unable to achieve the target price because the lows are increasing, right? The chance of hitting this top, after a breakout above this level, chance is higher than achieving your target, right? Therefore, that is the reason for that is because of this uptrend. The primary trend is upward. So taking positions onto the opposite direction of a trend will not be successful unless it is an aggressive, very, with very small return on investments, it won't succeed. But if you go the others, go along with the trend, you never would have, the chances of success rate would have been higher compared to that, So that is very important when it comes to the, following the patterns, right? So, especially when you are trading or taking positions, when you want to accumulate on weakness, on price weakness, or what is known as buying the dips. You can do buying the dips, but there again, you can, you can make use of these bullish engulfing patterns if you want to buy the dip, right? So either to accumulate or to trade, you have to understand the importance of the major trend. From there, I'll be moving on to the other pattern, which is a little bit similar to understand with the engulfing patterns, which is known as Harami. Now, in the case of the Haramis, also the same story. You have two types of Haramis, right? By using the bodies of the candles. Now, there are two, as I mentioned, the two types of bullish and bearish Haramis. Again, these are reversal patterns. Before explaining it, there are two questions or something. Let's see that. Does it only important candlesticks happening at swing low and swing high? What about the pattern in between? Okay, how theoretically identify consolidation is going on, kind of consolidation, how important to identify consolidation, how to use for our favor, right? So your Tushar is asking about the consolidations that can be used in our favor. At the same time, about the candlestick patterns, the importance of candlesticks as far as swing lows and swing highs are concerned. What about the pattern in between, right? So first of all, let's I will go through this pattern and then I will answer your question. Now over here, remember I was showing you engulfing patterns. In the engulfing patterns, the second candle overshadows or engulf the first candle, especially the body of the first candle is engulfed. Now something like this. Here there is a bullish engulfing pattern. Here you have a bullish engulfing pattern. Here you have a bullish engulfing pattern. Then also I said, now here the first is shorter in nature. The second candle is longer. But this is the opposite way, right? Here you can see that the first candle's body is tall, right? And the second candle, the body of the second candle is short, right? So that is called a Harami. At the same time, it is we have to understand that we are once again not interested, or we don't take into consideration the shadows, meaning the upper and the lower shadows. We don't take into consideration. We only take the two bodies of the candles, right? So here a bearish Harami happens after a pause at the resistance level or the resistance zone, right? Resistance level or the resistance zone. Over here you can see there is a pause here and there is a resistance zone here, and in between you see that there is a bearish Harami formation here. Thereafter we can see at the bottom, after this drop, there is a pause within a support range, and you can see that there is a bullish Harami formation here, where the body of the first candle is taller than the body of the second candle, right? So this is known as a bullish Harami at a support zone. if you see a thing like this, and if there is going to be the next candle, if you see what do you call a breakout above this candle, it will be very important. And when you are trading a bullish Harami, what we do is we first, or rather we put a GTC order at the high of the first candle, at the high of the first candle, right? Because it has to break, that high has to be broken out for this bullish Harami pattern expectation to happen, right? Because at any given moment, an uptrend happens when a resistance is broken. So the immediate resistance is the previous day's high. Right now, this high is 89.99, and that 89.99 or 89, let's say 90 rupees. That 90 rupees has to be broken, and that is what happened at on the first candle after the pattern. So what we do is, the moment we see end of day trading, we see a bullish Harami formation. If you are interested in this stock, if you believe in this stock, then we can put a GTC order at that price. Meaning, it's not just a GTC order. It has to be a buy stop limit order. Buy stop limit order, right? In online trading, if you are using your online platform, it is very important that you understand how the buy stop limit is entered, how you are going to use the buy stop limit. It is very important, especially when you have analyzed your company, you believe in the forward potential of the company, the future potential of the company, and then you want to accumulate. At the same time, you want to trade in it, or when you are accumulating, you want to accumulate when the prices are increasing, meaning there are breakouts of resistance levels. Then buy stop limit order is very important. So mastering it, understanding it, first obviously you have to understand it, study the concept behind it, then you will really be rewarded out of it. So you can benefit by this bullish Harami pattern if you make use of the buy stop limit order. Answering Tushara's questions, right? Now, first of all, the swing high and the swing low. If you just sit back and just try to focus onto a chart, you will see, right? I'm always telling, and I'm a person who is very closely looking at waves, and it's not only me, every one of us must do that. The wave always has an up wave. An upward wave has a low and a high. You have a low point and a high point to have an upward wave. In an upward wave, the low is the starting point, and the high is the ending point. In a downward wave, the high is the starting point and the low is the ending point, right? Here you have a low, which is the starting point of this upward wave, and this is the ending point. Then for the downward wave, this is the starting point and this is the ending point. And over here, again, we can figure out a certain low. You can see in this instance, there had been a very strong horizontal support level at a certain price around 80-90 area. Therefore, we can understand that that is the area where the turning point is happening. So this is the starting point of this upward wave, and this is the ending point. Now, when you look at these starting points, meaning the lows and the and the highs over here, you will see that there are always 3 candle swing low and swing high formations, right? At the same time, you will see that there are instances where the swing high and the swing low of those waves are very strong and very visible. They are easily recognizable, right? So you have those points. The next question Tushara asked on the similar subject is whether those levels or the swing highs and the swing lows can happen in between a wave. By all means, it can happen. The reason is waves are not just, you don't see fixed waves. Within a wave, you see additional waves, right? Now, if you go to study the wave theory called Elliott wave theory, right? The concept of the Elliott wave theory is that you have different types of waves, right? The smallest waves to the largest waves. Sometimes the smallest waves will be visible in very, very short time frames, like 5 minutes. Or some people, if the data is so wide, they even use the 1 minute chart, right? That is for the smallest fractional waves. Then for the longest waves, some use monthly charts or other monthly time frames. Sometimes based on their analysis, some waves are longer than 1 year, right? So what it means is that every wave will have very small waves, right? The reason is now we are in the 1 day chart. So 1 day chart has these waves, right? So when we are analyzing a wave, as I mentioned, easily recognizable swing lows and swing highs we take. Not only the swing highs and the swing lows, of course, whatever easily recognizable low we will take. Here you don't see a swing low formation, right? But these two candles, the lows of these two candles are lower than these lows and these lows. So this area is the lowest low area, right? Over here you have this area, right? Which is the highest high area. In between you see another high here, then a low here, right? Then of course here there is a continuation, but there's a pause here, then again a reversal here. So these are all waves. So when we break it down from 1 day to maybe 1 hour to maybe 15 minutes to maybe 5 minutes to maybe 1 minute, but in our market, as I mentioned, more than 5 minutes not worth looking at. One minute doesn't worth the time looking at, because our data is not that great most of the time, right? In certain instances, most probably you might see, but ideally the 5 minutes is the shortest, right? So when you break the daily chart into 5 minutes, you will see many other waves forming. Therefore, when we are looking at waves, right, by all means, you can go to the shorter time frames. At the same time, to get a bigger picture, you can always go to the monthly chart or the weekly chart. I'm sorry, though I mentioned that this is a daily chart. Actually, this is not a daily chart. This is a monthly chart. I normally use the daily chart, so I thought I was under the impression that I'm still in a daily chart. But here, this is a monthly chart. So that's why you see these waves. At the same time, as I mentioned, you can go to the shorter time frames. Right? That is the first question he asked. The second was consolidations. Right? Now, consolidation is a very, very important concept every one of us need to master. Right? What is the thinking, the price action behind a consolidation? every given moment, you have a buyer and a seller. If there are no buyers, you can't sell. If there are no sellers, you can't buy, right? That is just like us breathing, inhaling and exhaling, right? If we don't exhale, we can't inhale. If we don't inhale, we can't exhale. So that is like, you know, that is like free air that we have. Because of that, we don't really, you know, take it seriously. This buying and selling concept, we don't take it seriously. But that is the most important thing that we have to take seriously, right? That's why I mentioned that at a pause, when there is an uptrend, there is a pause, and that pause is called a resistance. In an uptrend, when there's a pause, it is a resistance. At the same time, you have a resistance point and a resistance level, right? When you understand these candlestick formations more and more, you will understand why the resistance point is formed and why a resistance area is formed, right? Remember, when the uptrend pauses, you have a resistance. Just because there's a resistance doesn't mean that you have only sellers. You have buyers as well, right? At the same time, even at that point, right, the buyers and the sellers, they compete with each other in order either to take it up above the resistance levels or bring it down below the support levels. Anytime when you have a range like that, right, you will end up seeing a support level and a resistance level in a resistance zone, right? Now, let's, I mean, if I want to elaborate a little bit more on that, take this candle. Obviously, this is longer because it's a monthly candle, right? So the entire month, it has gone from a low of 77.81. You have to excuse these odd figures because the prices have got adjusted for the splits that you can see all over, right? Especially all these splits, the price have got adjusted. That's why you have odd figures. But take the concept, right? Here you will see from 77.80 to 122.70, right? So that is a range, right? As far as that month range is concerned, right, it is very important for that month, right, coming to the next month, where the high of this month has to be broken out if the prices that started going up from here, or from starting from here, if the prices have to go up, right, the high over here has to be broken. If the market to come down, then the low here has to be broken. So you have a price range here. If by any chance the prices go sideways within this range, right, that is known as a consolidation. Within a consolidation, you see there is accumulation happening, right? Accumulation is something that the buyers are doing, right? And at the same time, you see distribution happening. Distribution is something that the sellers are doing. They are selling, which is known as distribution. Buyers are buying, which is known as accumulation. So that demand and supply is what is happening where the accumulation or distribution takes place, and that area, wherever it is, how long, how short that range is, called the consolidation, right? It can happen, as I said, in this range. This is the resistance level, resistance point. This is the support level, support point, right? But this in the overall picture, because it has gone up and paused, this is an area of resistance. From here to here, there is an area of resistance, right? You can see from here to this level, what has happened. If we move forward, right, you will see what has happened, right? So this candle itself had become very, very important candle, right? You can see the consolidation up to this level, right, took place, where the accumulation was better off than the distribution. That's why the prices started going up. The demand, the buying power, or the buyers kept on paying premiums to the sellers, thereby breaking out at this point the high that was there, that was registered here, and from there it started extending, right? So just imagine, this is in 2014 June, and this is in 2010 September. 2010 September to 2014 June, right? This accumulation and distribution took place. That's why I said you have, this is a monthly chart, right? That's why I said you have very short waves to very long waves, spanning from minutes to years, right? So the more you look at this price action, the more humble you will become. The more you look at the price action, the more patient you will become. The more you look at the price action, the more broad-minded you will become. Okay, so I think I managed to answer those two questions. If you have any further questions, any of y'all can just jot it down on the chat. I will try and answer them. I'm just logged in, so logged in. Could you please explain swing high and swing and low, please? Thank you very much. Okay, fine. A swing low is a 3-candle formation. In the 3-candle formation of a swing low, you have a low, lower low, and a higher low. A low, lower low, and a higher low. You can see a swing low here. The low of this candle is 56.90. The low of this candle is 47.70. So this the low, this is the lower low. Then the low of this candle is 58.18, higher low. And this low is the lowest. And these 3 candles forms a swing low formation, in which when we see a swing low like this, we describe the swing low as the value that you see in the middle, the low of the middle candle. The low of the middle candle is 47.70 or 47.80. So the swing low is therefore 47.80. A swing high, right? Swing high is when you have a high, then a higher high, and lower high. High, higher high, and a lower high. Right? High, higher high, and a lower high. You have a high here. You have a higher high here. Then you have a lower high here. Again, just like that, you have a high here, you have a higher high here, you have a lower high here. So both these are swing highs. amongst them, this is the highest, right? So we take this swing high as against this swing high, right? So it's a 3-candle formation. When we say swing high is 157.70, that means the high out of the 3 candles is the middle high, and high out of the 3 candles is at 157.70. Over here, the high is 170.10. Therefore, in that swing high, the value is 170.10. That is how we interpret a swing high and a swing low. Incidentally, it does not necessarily mean that you need to have a longer upper shadow or a longer lower shadow. Not necessary, right? You can see something like this. Over here, you don't have tails. These are shaven-headed candles, right? In this, remember I mentioned about the meanings of these Marubosu candles. These are very bullish or bearish candles, right? So that because of that itself, we have to respect the formation, right? So at this point, we see both candles had almost the same level, right? Same level of value. Therefore, this can be considered as a low. Also can be considered as a swing low, but not the ideal formation. But this is a low, a base, or otherwise we can call it the lowest low, right? So either a lowest low or a swing low is important when we are analyzing waves. Fine. So from here, let's move on to the next pattern, which is called the Harami Cross. Now, incidentally, the Haramis have visible bodies, right? Then you have another Harami called the Harami Cross. But in the Sri Lankan market, I searched, we don't have too much of Harami crosses, right? Of course, the bullish and the bearish engulfing formations are there most of the time, but having Harami crosses is a little bit infrequent, I would say. It won't happen frequently, right? It's something that I search for, and this is something, I mean, one of the closest that I managed to get to. In the case of the Harami Cross, just like the normal Haramis, you have a tall body. In this instance, it's a red body, and then a doji. Ideally, this doji has to be inside and it has to be smaller, but that does not, I mean, it doesn't mean that we cannot call this a Harami, right? A Harami is a dual candle pattern, and this is known as a bearish Harami. A bearish Harami is when there is a downtrend. As a result of that, you have a bearish close here, and then you see a doji candle here. Doji is not telling anything as far as the direction, change of direction is concerned. But when you see a candle, I mean a 2-candle formation like this, it is very interesting. It is important to understand what will happen to the next candles. Just like in the Harami, you can put a GTC, or you can watch whether the prices are eventually going to break this high, right? So the moment that breakout takes place, there can be an upward movement, right? So just like understanding the behavior, resistance breakout, we need to understand that now here, this is an hourly chart. In the hourly chart, this hourly high, the previous hour's high, has to be broken. In a monthly chart, it has to be the previous high of the previous month has to be broken. In a daily chart, the immediate thing that has to happen, right, is the breaking out of the previous day's high. Then the prices are coming down the other way around, right? In an hourly chart, if by any chance this was not an accurate formation, then you would have seen that the low of this candle would have been broken and the prices would have come down. But here it didn't happen. Right? So that is a Harami cross. Thereafter, we will be going into the piercing candle and the dark cloud cover. The piercing candle and the dark cloud cover are the same thing in opposite directions, right? What it means is that a dark cloud cover is when the prices go up and at some point the price opens higher than the previous close, right? And it can go up further. You open at this level, go up further, and then when it is coming down or close, it has to close 50% into the previous day's candle or the previous time period's candle. That is called a dark cloud cover, right? And that trend would be confirmed when the next candle breaks below this low, right? Which is the support. The candle's support has to be broken. If this formation takes place, the previous day's candle support has to be broken and then the prices have to come down, which happened here. That does not necessarily mean that everything, the downtrend will go on forever. All these patterns, remember, any pattern, whether it's the chart patterns or candlestick patterns, there are, if you are using a daily chart, right, it will be in existence within days. If you are looking at monthly charts, in months, hourly charts, in hours, 5-minute charts at that point. So when you are using these time periods, you need to understand that your thinking pattern has to be in line with the time period that you are using, right? If you are using a 5-minute chart, you can't have the same mindset that you need to have on a monthly chart, right? If your thinking is it takes time to change, then you shouldn't be trading the 5-minute chart. Or otherwise, you have to train yourself to think quickly in a 5-minute chart. Think faster, right? You cannot. The moment you come into a chart and you have decided to follow a 5-minute chart, then you need to understand that your thinking has to be much faster than the normal, right? So that is another important thing that we need to understand, right? Okay, now this, you can see, this is not a bearish engulfing pattern. The reason is the red candle is shorter. The body of the red candle is shorter than the body of the green candle. But at the same time, it has not started above the green candle's close, right? The green candle's close had been 39 rupees. The next day's open is 39 rupees. So this is not a typical dark cloud cover, but the fact that it has closed below 50% of the previous day's candle, right, could be considered as a dark cloud cover, provided that the close of the green candle has to be breached, the support has to be broken, and the prices have to start coming down. Then that formation will stand strong. Then from the dark cloud cover, we move on to the piercing candle. The piercing candle is the same on the opposite direction. Right? You can see these two candles. You can see these two candles. You can see the close here, which is at 21 rupees. The open of the previous, the following day is at 2060. Closes at 21.20. The first day. Second day, it is opening at 2060 and moving to close at 2067. Let's say 2060 or 2070. Thereby, what has happened is that it has pierced into the territory of the body of the previous day's candle and surpassed the 50% area. That is a classic piercing candle, right? Then you see here another dark cloud cover, but over here another piercing candle, but you know, the range is very small. Here another typical piercing candle, and as I mentioned, this is a dark cloud cover. This is a piercing candle formation. So that is as far as the piercing candles and dark cloud cover patterns are concerned. Opens higher or lower, pierces at least 50% into the body of the previous candle. That is the idea behind it, right? Opens higher or lower means in a piercing candle, opens lower against the previous candle, opens lower against the previous candle, and closes 50% and above of the previous candle. That's a piercing candle pattern. Dark cloud cover is the opposite direction, where it opens higher. Here it opens lower. Here it opens higher and pierces into the body of the previous day. More than 50% or up to even 50% is okay, right? Ideal formations again is when these are at the top of the ranges, but of course, you know, at this point we don't know whether this is the top of the range. I mean, end of the day, if you take this rally, this is not the top of the range. But then, if you just go like this, wait. Showing this area, but if you go like this at this point, this is the top of the range, right? So that's why this is important. No, I'm sorry, no, that one I was. Sorry, here, this one goes up, you are here, it's a dark cloud cover, right? So at this point, we don't know whether the prices are going to come down or not, but we have to respect it because it's a dark cloud cover. Now, incidentally, this we can just go through and see whether it's a dark cloud cover. You know, you use the Fibonacci lines, or you know, you can just use a calculator at the high and the low. I'm sorry, at the open and the close. You add the open and the close of this body of this candle and divide that by 2, then you will get the 50%. Right here, let's see whether it is 50% by using the Fibonacci retracements. The 50% is here. Right, so it has come down to that level. In fact, it has pierced much more steeper than that and have come and closed at this level. So this is another very important piercing candle formation, before this level. Right, so at that point, there was a pause and a trend reversal. So, when you see, I'm sorry, this is not the piercing candle, this is a dark cloud cover. This is a classic dark cloud cover formation. At the top, there is a reversal. This is a piercing candle. At this area, after this fall, had formed a piercing candle formation. And over here, after this top, you can see that there is a piercing formation. And this is not really a piercing formation because it has not, the body has not breached 50% of this level, right? And then finally, I'll cover the tweezers. That's also a dual pattern, dual candle pattern. Now, interestingly, in the piercing, or rather the tweezers, also you will see the tweezers at the bottom. I mean, ideally at the bottom of a trend or the top of the trend. As a result, the tweezers are called the tweezer bottoms and tweezer tops. Now, the important thing in the tweezer that for us to understand is that the range of the two candles will be the same. The range of the two candles will be the same as we can see here, right? If you pay close attention to these two candles, this candle, you can see the range, that is the low and the high, is 162.50 to 166 rupees, right? But it is something like, it is not really a hammer, but you have a body with a lower tail. You have a red body with a lower tail. And the range is 162.50 to 166. Look at the other one, the following one, 162.50 to 166. But it is upside down, right? So that's a tweezer. But it's not the same because the commonly used tweezers have both colors. But now the fact that it has come into play after the pause in a support area, it has acted as a tweezer bottom reversal. This is at the support, right? Now over here, this is a more accurate tweezer, which is called the tweezer top. In this instance, you can see the range of the green candle where the upper wick or the upper shadow is long and you don't see any shadow at the bottom, and with a green close or rather a bullish close, you can see the bottom is 193.25, the high is 197.50. The red candle where the lower tail is visible, it is 193 to 197.50. Here it's 193.25. So it's just a matter of 25 cents difference. But you can see that it is almost like similar in formation. Therefore, it is a tweezer. And it is known as a tweezer top. And it has happened at the top of a range. Right? So that's basically what we have for dual pattern formations. And next week, we will be taking you all through the triple pattern or the three candlestick patterns. If you have any further questions, free to fire them up. Right. Tushara is asking, how do we understand prices weak when market up and vice versa. That's exactly what I just now explained. You know, these are called, all these patterns that I mentioned can happen. From the start I was talking, at the resistance area, these patterns will form a reversal to the bottom. At the support areas, these patterns will form for a reversal to the top, right? So here also you can see this is a tweezer top. We have to wait and see what will happen, but it is at the top, right? If you are believing that this is a reversal pattern, then it has to break the low of this level, which is already has happened, 193. The close is 193. So if by any chance it comes down below that, then this pattern, the expectation that we had with this pattern will become true. Here also it has, after a support from this resistance came down to a support, and then it started moving up, right? So that's how we look at the reversal patterns. Right, how do you interpret tweezer? Tweezer, as I mentioned, happens when the two candles have the similar price range. When you see these candles having similar price ranges, right, and they are called tweezers. Most importantly, if you go to some, very, let's say penny stocks, if you look at penny stocks, you will see many tweezers, right? So now that's a challenge that people will be having. Look at all these are at similar levels, right? One is a green candle, the other one is a red candle. Sometimes you will see with a tail, right? You have, of course, this is different. This is a 1 hour chart. If you take a 2 hour chart, I'm sorry, a day chart, you will see all these are tweezers, right? If you take some of these count, basically most of these candles are within the same ranges, right? So so that's why it's challenging, and because end of the day you have many tweezers, right? So that itself will help you to understand where at which point you need to collect. If you believe in a stock, a penny stock like Nation Lanka, you can do that. So the important thing is that when you see candles within the same range between the low and the high, then those are known as tweezers. But as I showed on the previous example, the case of Expo Lanka, right, you have a similar range here, but you can see that when the prices are going up, ends up with a bullish close at a range, and the following candle ends up in the same range with a bearish close, then we have to focus onto this breakout below the support of this candle. That is how this is called the tweezer top, because there is a uptrend. Then there is an indication of a reversal. We don't know until it comes down below this and closes. Here the other way around, the prices come down, and at this level it's a bottom. Ideally the bottom would have been here, but this bottom happened after this rally. So we have to respect this support, because you have a low here which is higher than this low, right? So this is another reversal. So you see a drop, then you see a bearish close here. Then again over this, of course, you have another bearish close in the same range, but as such it's almost something like an indecisive formation. So you need to wait for whether the breakout below the support happens or breakout above the resistance takes place. And here you can see the breakout above the resistance took the prices, managed to extend the price to a higher level, higher than even the levels that we saw here, right? So that is how we can interpret the tweezers. You see, apart from, as far as these two dual candle patterns are concerned, the engulfing patterns are very easily recognized and frequently happening, whereas the next best in the Sri Lankan market are the Haramis, but the others like the piercing, third best I would say the piercing candles and piercing pattern and the dark cloud cover pattern. The tweezers are not frequently visible, and also these Haramis, if you take the Harami with the Doji Haramis, the Doji engulfing patterns, those are not frequently seen in our market. Right, Jeevanti is asking whether the tweezers are happening at the top or the bottom. Yeah, you see, I mean, tweezers happening at the bottom, tweezers happening at the top will make the necessary, the respective reversals. Meaning a tweezer at the bottom can expect a reversal to the up. Tweezer at the top can expect a reversal to the bottom. But it will happen only with a breakout. The bottom, the tweezer bottoms need to see a breakout above the resistance level of those tweezer ranges. The tweezer top has to see a breakout below the support of the range of the two candles. Then only we will see that. And in the meantime, you will see tweezers in between a wave also, that also can be seen. So Harin, I think basically we have come like, we have extended about 15 minutes. I'll hand it over to you, Harin.
Thank you, Mr. Saliya, for the wonderful session. So are there any doubts or are there any clarifications? I'll be dropping anyways, I'll be dropping the recording of the session to everyone who attended today. And with that being said, if there are any doubts, just feel free to ask or drop Mr. Saliya a message. Yeah, so finally, I would like to conclude, and also I would like to thank Mr. Saliya for the wonderful sessions, and also the past sessions has been very incentive, and thank you very much. And if there are any doubts, please feel free to email us and also contact us. So thank you once again.